Eric Sprott, Rick Rule, and Keith Neumeier are three successful resource investors coming together for one simple reason: to buy cheap assets from distressed companies and seize this once-in-a-decade opportunity to buy gold, silver, and other mineral projects for pennies on the dollar. First Mining Finance Corp., trading on the TSX Venture under FF, a recently launched venture with the sole purpose to acquire advanced stage natural resource projects, and starting on day one with 18 projects, management has already identified over 60 additional projects to acquire. Learn more about First Mining Finance at futuremoneytrends.com/investright.
Well, hello everyone, and welcome into crushthestreet.com. My name is Kenneth Amaduri, and today we're joined with Jordan Roy-Byrne. He's a CMT, chartered market technician, and a member of the Market Technicians Association. And he's the publisher and editor of The Daily Gold, a premium service, and The Daily Gold Global. He's also the author of the 2015 book, The Coming Renewal of Gold's Secular Bull Market, which is available for free. Jordan's been featured on many blogs, many famous sites: CNBC, Barrons, Financial Times, Kitco, the list goes on. And Jordan, the first time I got to know you was at, I think, the San Francisco Hard Asset Show a few years ago, back when gold was a little more popular. So I'm interested to have this conversation with you. First of all, thanks for coming on the show with me today.
Well, Kenneth, thanks for having me, and thanks so much for that very nice introduction.
No problem. Well, you know, the markets are a crazy thing, and the economy is a crazy thing, and we're always just trying to get an idea and a feel for how to proceed forward, and that's why we have you on. We're here to hopefully get some direction as to how to proceed in these crazy times. So with that, Jordan, why don't you just kind of tell us a little bit about yourself, and what is a chartered market technician for those who might not be familiar with that?
Well, a chartered market technician, it's somewhat similar to the CFA that a lot of people get. I mean, the CFA, it focuses more on the fundamental side of the markets, and I know if you go that route, you have to study quite a bit of economics, finance, accounting. And so you're if you want to be an analyst that analyzes companies professionally as far as those types of metrics, then the CFA is a good thing to get. And the CMT is not, I don't know when it was developed. I know it's relatively new. I want to say it was developed sometime in the 90s, but in the respect that professionally, well, I should say professionally, it's, I think the people who developed the CMT, like Ralph Acampora and the famous technical analysts of years and decades past, I think they wanted to have something that was comparable to the CFA, but for people who look at charts and focus on technicals of the market. So that should, there's always the argument fundamental versus technical analysis, and so if you're a professional on the fundamental side, the CFA is something you would try and go after, whereas if you want to focus on the technical side, you would try and get the CMT certification. So, and to kind of fuse that into my background, I mean, I started investing when I was young in the 90s, and I thought I knew everything because I got in early on the tech bubble, and then when that fell apart, I thought, there really has to be a better way of understanding the market and how it trades and why it moves. And so I started reading a lot of books on technical analysis, and so that's what got me started on technical analysis. But I do believe that it's best to fuse technical and the technical and the fundamental together. You really should use all tools at your disposal. I mean, that'll help give you more information and make you a better investor or a trader. But professionally, I'm definitely more well versed on the technical side. So that's that's a little bit about me and how I became a technical analyst. And I started writing a free newsletter in 2005, and then that grew slowly, and I started a paid newsletter. And then in 2009, I turned it into The Daily Gold, and that's where I am today. I mean, I thought that gold was in a secular bull market, And I still believe that's going to be the case, although there's probably a lot more debate about that today than a couple years ago or 5 years ago. But that's why I've been focusing on gold.
Yeah, I mean, let's talk about that. A few years ago, it was hitting. It hit a high in 2011, and then since then, we've been steadily going down. And it's debatable as to if we hit the bottom or if we are going to see lower lows in the near future. So, but as of the last month or so, precious metals and the mining stocks have seemed to pick up some momentum. So what's your current sentiment with gold and, the mining sector at the moment?
Well, I think it's tough to get a read on, normally I have a strong opinion or strong conclusions either way, but I think it's tough to get a read on, because if you look at the mining space, I think if you compare the bear market, the real devastating bear market from 96 to 2000 to the one today, I mean, it depends what indexes you look at. Like if you look at the Huey Gold Bugs Index, I believe it made its low a couple months ago around 100. That's, in terms of price, that's just about equal to what happened from 96 to 2000. As far as time, the 96 to 2000 bear is a little bit longer than what we have now. But if you look at other indices like the Barrons Gold Mining Index, which goes back to 1938, and then also if you look at the XAU and the GDM, which is if you look on stock charts and you put in dollar GDM, I think it's the NYSE ARCA Gold Miners Index, but that goes back, I think, about 20 years, and that's what the GDX ETF is based off of. And all those indices in terms of price have exceeded the bear market from 96 to 2000. So, I mean, given that, we're essentially at the worst bear market ever for the gold stocks, and this has now been going on for more than 4 years. And so the mining stocks are just really ripe to have a turnaround at some point. I mean, it's a very cyclical industry. It will happen at some point. And the question is, I mean, have we seen the start of something over the last couple months? And I'm not totally certain that that's happened. I'm still a little skeptical, and I'm more skeptical about the metals. I mean, they have had a nice move here, and I'm kind of wondering to myself, if we do have a pretty good rally here, and this can continue for a couple more months, then maybe the miners have bottomed, and maybe it's even possible that the miners will bottom before the metals, and the metals might have a lower low in the future, just because the mining stocks have become so extremely oversold and they peaked before the metals. So it's possible, and this happened at the 2000-2001 bottom, where the mining stocks bottomed first ahead of the metals. So that's a scenario I think could possibly play out. But just getting back to the metals, there's two reasons why I'm skeptical that they've bottomed. Number one, the dollar has been weak and correcting for 5, 6, 7 months, and I mean, it looks like it can go a little bit lower. It can possibly go to 93, maybe even a little bit below that. But if you take a big step back, the dollar is still in a major uptrend. I mean, it's been consolidating and correcting the huge advance that it had. So I think the dollar is likely to have another leg higher at some point in the months ahead, even though in the very short term it looks weak. And typically what happens is gold tends to bottom 4 or 5 months before major peaks in the dollar. And so if the dollar had a major peak 6 or 7 months ago, gold, I mean, if that were the case, gold should be performing a lot better. So even though the dollar peaked 6 or 7 months ago, gold has basically done nothing over that period. If that was a major bottom, gold would be performing a lot better. So that's one reason I'm skeptical. The other reason is if you look at the commitment of traders reports, and you look at the net speculative position, which is basically the speculators, what are their gross longs, you add it with their gross shorts, and you get a net position. And I like to measure those against open interest because it gives you a clean percentage, and then you can go back and look at the past 20, 25 years. But anyway, if you look at the gross long positions over the last several years, there really hasn't been a capitulation in gold and silver as far as the traders. And I mean, we know that sentiment is really negative. We know we're at some point very, very close to going into this bear market ending and then getting back into a bull market. But just looking at the COT data, the speculators have not cut their long positions. They've not capitulated in any way over the last couple years. And that's just a big concern to me. And of course, technically, gold has really, really strong support from 970 to 1,000. It has bottomed temporarily around 1080, which is the 50% retracement of the entire bull market. So, I mean, it is possible that gold has bottomed, but for these reasons, I'm still skeptical, and I think that we're going to see another leg down. I don't know if it's going to start in a month or 2 or 3 months. It's hard to say, but given that long answer, you can tell that at least in my view, there's a lot of possibilities as to how this could play out in the next several months. But I do believe if we do get another leg lower in the metals, I do think that's going to be the last leg lower. And then after that, we'd see a new bull market begin.
Definitely a lot of possibilities. And you talked about the technical aspect to the trades. And I want to ask you about some of the fundamental aspects. And one of the big issues and debates that people kind of go back and forth with is what's going to happen with the federal interest rates, the Federal Reserve rates. And a lot of our alternative economists that we've interviewed on this show believe that the Fed funds rate is essentially going nowhere. So what do you see differently happening in your thinking that they could possibly raise rates, and how that will impact the precious metals?
Oh, very good question. Well, the fundamentals of precious metals are really derived from rates. And that's basically interest rates minus inflation. Because when real interest rates are going down, or when they're strongly negative, then you're not making any money holding your money in a bank or buying a CD or a bond. And therefore, that makes gold a lot more intriguing, and it basically, gold doesn't yield anything. So if you put your money in the bank and you're earning a negative rate of interest, if you buy gold, you're earning zero interest. But it's better than losing a real rate of return on those other instruments. So that's the environment where gold performs best. And the problem over the last 4 years during this bear market is 4 years ago, real interest rates, and you can look at the Fed funds rate, you can look at the 5-year bond, you can look at a 2-year bond. There's so many ways you can measure real interest rates, but looking at the Fed funds rate and the 5-year bond, 4 years ago, real interest rates were around minus 4%, and they've basically gone down to zero. So fundamentally, over the last 4 years, gold has been less desirable to hold because negative real interest rates have gone down. They've trended from minus 4 down to zero. So they're still around zero right now, which in general supports gold, but they were minus 4 years ago. And so what we need to see for gold to start going up again is we need to see real interest rates go down to at least minus 1 or minus 2%. So the way that happens is inflation starts going up faster than rates, or rates start going down faster than inflation goes down. So that's kind of where you get your deflation being positive for gold, and of course inflation being positive for gold. And so, and with regards to Fed policy, even in the scenario that the Fed would raise rates, you could see gold do really well, and perhaps a Fed hike mark a bottom in gold, because the Fed, I mean, they're always easy. Other than Paul Volcker in 1980, 81, they never will raise rates fast enough to contain inflation. So the Fed will raise rates when they see that inflation is starting to go up. And so they'll raise rates once or twice or whatever, and inflation will keep going up faster than rates, and that would be very bullish for precious metals. So that's something to keep in mind from a contrary point of view. And if they're able to hike rates, I mean, we've all been waiting for it. It's been, priced into the market. Well, at least, they go back and forth on it. But if they do raise rates at some point next year, I think it's possible that could really mark the end of this bear market for precious metals. Now, on the other hand, there's also the scenario that the economy is really too weak for them to raise rates, which is definitely looks to be the case right now. And in that scenario, we need to see inflation pick up, or we need to see rates really plummet for gold to do well. And we have seen in the last couple months, I mean, rates are going down, and so that's helping out gold. But to get back to what I'm looking for, and I guess I can tie in the stock market into this, but the stock market, the S&P 500, kind of around 1860 or so, those are the lows from recently and also from 2014. If the stock market breaks those lows, I think that would be very bullish for precious metals. So that's one scenario. The other scenario is that the stock market is able to hold up here and it trades around the highs in the next 3 or 6 months, and then the Fed decides they're going to raise rates. That would also that would be the other scenario that I talked about, where you could see the Fed hike rates, but gold bottoms at that time.
Yeah, no, it's interesting, the paradigm that you have on that. And I was actually going to ask you about the stock market with coming up here. So are you kind of just in between on what you think could potentially happen with stocks, with them trading where they're at, possibly going higher, or taking a leg down and seeing some a very major correction?
Yeah, I mean, looking at where U.S. equities are right now, I mean, they have that important support in the 1860s. And, I mean, zooming into the near term, we've had a good rebound here. So I think over the next week or two, stocks might be weak. I don't think stocks are headed for another big leg down just yet. I think the bottom that they put in is probably going to hold up for, 2, 3, 4 months maybe. But if we go out, further than that, I think it's possible that the stocks could start and roll over again, and then maybe at some point in the first quarter next year, second quarter, they test the lows around 1860 and possibly have a major breakdown at that point. Because if the stock market loses those recent lows and the 2014 lows, then we're going to have like a 30% bear market at least. Over the next couple months, I do think those lows are going to hold. They're not a threat to break, but we'll see what happens. If we spoke again 3 or 4 months from now, I think we'd have a better idea to see if those lows are really going to hold for a while, or if the market looks like it's weakening, is going to break below those lows. So those are the scenarios that we have to keep in mind for the stock market.
So definitely keep an eye out for those numbers, for some technical indicators. Jordan, I wanted to ask you this in conclusion. Why buy gold when silver, you can get, so gold is trading 72 times the price of silver at the moment. Why buy gold at these kind of numbers?
Well, that's a very good question. I mean, looking at why buy gold, silver is, I think you're asking why buy gold instead of silver.
Right, yeah.
And that's an excellent question. I think it really depends on the person, because gold is going to be less volatile and it's going to have less upside potential. But it's not going to move, like I said, it's going to have less volatility, so it won't move up or down as much. But for someone who wants to be a little more conservative and they want more liquidity, I think I would favor gold. but for a younger person, they're able to tolerate more risk and more volatility, but perhaps more upside potential over the next 5 or 6 years, that I think silver would be a better bet. I mean, I obviously like both a lot. I think both are going to move a lot higher in the next several years to the next 5 or 6 years. But look at, and even dragging the stocks into this, should you buy the stocks or the metal? I think it really depends on people. I always tell my subscribers, you need to figure out your own situation. Take the information and analysis that you get and apply it to your own situation. Figure out what's best for you. I mean, if someone's a retiree and they want less risk, but they do like gold, then gold would probably work better for them than silver. Whereas for younger people, they can afford more risk and that sort of thing. Then I think silver would be a better buy for them. And the gold-silver ratio, last comment, that hit, I think it hit important resistance if you're looking at a 20 or 30-year chart of the gold-silver ratio. So silver is outperforming here in the short term, and that's definitely something to keep an eye on, because silver started this bear market before gold did. So silver might be a leading indicator as to when we're going to come out of this.
Jordan, you've shared with us a lot of important information, and I appreciate you coming on the show with us. If people want to reach out to you and get more information on you, where would they go? Again, I know we talked about that right at the beginning of the show, but maybe you can just kind of give everyone a little idea of what they would find and what they'll see at your site.
Well, my site has articles and editorials about gold, silver, the mining stocks, and also conventional markets. And I post the interviews that I do, and I do a video update once a week. TheDailyGold.com is my website. If you feel free to contact me, Jordan, at TheDailyGold.com. And also, I'm giving away my book for free. Just go to TheDailyGold.com/book. And you can get it there. It'll be automatically emailed back to you. That's how you can find my work, and that's how you can contact me. And thanks so much for the opportunity today, Kenneth.
Thanks so much, Jordan. I really appreciate it. You have a great day.
You too. Thanks.